the WPI number coming in early this morning, and we did see an easing of the WPI inflation. But the CPI number is also out, where the food inflation is at 2.69% versus 3.75% in the month of February. So that has also eased out a lot. The CPI and rural inflation stands at 3.25% versus 3.79% in the month of February. So there is a cooling off of that also. We were expecting the CPI number to come in at 3.5%. The urban inflation stands at 3.4% versus 3.3% in the month of February. But let me get in my colleague Ankur Mishra, who's standing by with the details and the fine print. Their CPI number also stands at 3.3% versus 3.6%. So it has moderated, and we were penciling in a 3.5%, but that has come in lower by 3.3%. But let's go across to my colleague Ankur Mishra, standing by with the fine print of the numbers. Over to you, Ankur.
Yes, the numbers on your screen, 3.34% CPI inflation has come in. The expectation was 3.5%. It is much better than what RBI had guided for. Remember, for Q1, Q2, Q3, Reserve Bank of India has projected that inflation will remain below 4%. To discuss this a soothing kind of a number, we have with us Madan Sabnavis, Dipti Deshpande, as well as Suvodeep Rakshit. Welcome to this discussion on CPI numbers. First, I would want to come to you, Madan. Do you think 3.34% number will give much comfort to Reserve Bank of India?
Given the fact that we were expecting also a number of 3.6%, the fact that we have seen both food inflation as well as core inflation is trending downwards, I think is good news. And if I combine with this with the fact that IMD has projected normal monsoon, I think that is actually critical going ahead, because actually what we're talking of is for the month of March, which may not be very material as far as the RBI is concerned. But given that RBI is banking on inflation coming well below their target of 4% for most of the time in fiscal 26, I think the monsoon news is the positive factor, though there would still be a bit of uncertainty in terms of core inflation, what would be an impact of tariffs on other countries, whether at all imported inflation could go higher. I think that will be a different set of issues. But I think this gives a lot of solace that the chief factor which has been driving inflation higher, that is food prices, is something which has actually bottomed out finally.
Yes, food inflation has definitely bottomed out, 2.69% versus 3.75% in February. But is it a downward trajectory? Suvodeep, I want to ask you this question. Do you think food prices are remaining better compared to what was the scenario last year now?
Yeah, certainly. I mean, see, the main problem with the food prices, the food inflation, was with the vegetable prices, right? And with vegetable prices now coming under control, I think for the at least for the foreseeable future, for the next 6 to 7 months, we do not see much of a pickup that we should be seeing in the food prices. All the other elements, whether it is spices, edible oil, etc., cereals, have been much more well behaved, and as such, the durable portion of the food inflation has been coming off. The volatile part of the food inflation, which one can which one can classify as, let's say, vegetable fruits, etc., that has been also coming off. And now we finally see the print on the food inflation coming at around 2.6%. Kind of is now, I would say, the comfort zone on the food inflation is visible. Going forward, as I said, in terms of the outlook, I think the inflation should be on the lower side. IMD's forecast of monsoon being above normal is also a positive, but we'll see how the monsoon pans out. And overall on the core inflation front, also we should see some comfort, except for, let's say, gold price, etc. Overall, from the global side of things, a disinflationary impact could be possible as a fallout of the trade and tariff disruptions. But we'll have to monitor how and what kind of measures are coming in, and accordingly, what is the impact on the core inflation. But core inflation broadly should be inching up. Food inflation should be kind of troughing out and should be falling in certain segments. And overall, the inflation should be around the 4% mark in the comfort zone of the RBI.
Right, Deepti, with the inflation now coming below 4%, and the projection is also there that in Q1, Q2, Q3, it will remain below the benchmark of Reserve Bank of India, that is the target of 4%. Do you think that there will be more probability of cutting rates now?
Yeah, I agree. So I think that is definitely a fact. One good piece of news, I think, in all this gloom and doom that's coming in from the global side. See, the downside or the downfall in food inflation was certainly something that we were expecting, not just because we had a good output, but it's also because there was a very comfortable base. The base effect itself is going to be responsible to bring down inflation. The worry, however, is that it's not the first time that food inflation, for instance, has crashed down to as low as -7%. The worry is basically that every time something like vegetable inflation that I said came down at -7, it comes down, it tends to go back up again. The second thing is that while the IMD has forecast an above normal monsoon, it's also true that last year's prediction was similar. About 104% is what we got at the end of it as a percentage of long period average, the rains. Despite that, we had an food inflation rate, which was higher in FY25 compared to FY24. Now, the reason there was we have a good output in terms of food grains, etc., but vegetables, because of unseasonal, factors of rain, heat waves, etc., they tend to have an edginess to their prices. Now, if that were to happen, then it could, act as a spoiler. But in the base case, I'd agree that the story changes this year. In FY26, we are expecting food inflation to come down, non-food inflation or core inflation to see a little bit of an upside. But despite that upside, it will still remain within the RBI's comfort zone. So we are expecting another 50 basis points rate cut by the RBI. When and how they do it will depend upon two factors. One is the trajectory of inflation. Definitely, but they'd also, be interested in seeing how past rate cuts are transmitted into the economy. So there could be, a pause or two in terms of policies when they want to bring about that nudge in the economy.
Madan, you would have heard Reserve Bank of India governor's commentary this time. Now he has kind of shifted goalposts from managing inflation, which is the mandate of Reserve Bank of India, but considering growth scenario more than inflation now, do you think with the kind of numbers which are coming in for past 2 months will give more fuel to fire, meaning you could see more actions?
Yeah, actually, you're right. I think the focus in the last two policies has definitely been more towards growth than inflation, because we have gotten fairly hospitable inflation numbers, which gives you that comfort that inflation is going to remain below this target of 4%. Now, it's a case of saying that the RBI has been doing a lot in order to make sure that there is enough liquidity. So now when you're lowering the rates, the case is saying that we would like the interest rates, that is the lending rates, to come down. Partly it's happening wherever the EBLR is involved. The rest of it would be contingent on the deposit rate. So that's a call which individual banks will be taking. Now, the important thing is that how much lower can the RBI really go? Now, today, if you go by the RBI's forecast of inflation being 4% for the year, let's assume that inflation would be largely at the range of 4%. Then if we're talking of a real return of 1.5%, I think a terminal point could be 5.5%, which means another 50 basis points cut in repo rate is something which we could expect. The timing more likely to be after the monsoon comes in, maybe August or a little later, depending upon the progress of the monsoon. Now, this time we should keep one thing in mind, that while the RBI's estimates of inflation are fairly stable for the first 3 quarters, we should remember that the October to December is particularly vulnerable, because this thing of tomatoes, onion, potatoes has always been a shock case for us, that it's become more a kind of a pattern now, that vegetable prices are going to go up very sharply on account of any kind of excessive rainfall or deficient rainfall during those particular months. That's one factor. Second, we should also remember that the government has actually increased the price of LPG. Now, that may not sound much, but if you just put it along with the rates in your CPI, we could be seeing an increase of at least 0.1% there. So that will be neither food nor core. Somewhere in between, there's another 0.1 coming in. So I think we will have to monitor all these numbers. RBI will be doing that before going in for any further rate cut. Right now, I think the focus seems to be more on ensuring the transmission takes place. What they have done is having VRR, OMOs, even at a time when the system has a surplus liquidity. So quite clearly, they want to ensure that the system has lots of liquidity and banks are in a position to lower the deposit rates and accordingly also the MCLRs.
Right. Just to put into perspective, March CPI inflation number of 3.34% is lowest since September 2019. And Suvodeep, you were talking about core inflation. Now, even as the vegetable prices or food inflation is coming down, the core inflation may remain elevated, if I have understood you correctly. What are the reasons for that?
See, one part is in terms of the base itself, there is a pickup that we should be seeing in the core inflation. The other part is in terms of the gold prices, which have been elevated and could continue to move up. And gold has a weight which is, well, it's not large, but it is substantial in terms of moving the needle. And if gold prices continue to increase in terms of gold jewelry, etc., that would impart an upside pressure on the core inflation. Also, in terms of if you look at the WPI side of things, and if you look at the manufactured products, etc., there is a pickup in terms of at least the year-on-year number that we are seeing on the core WPI inflation front. Of course, it's not a huge pass-through that we always see in terms of the WPI to the CPI, but input prices increasing will impact certain segments of the CPI basket, which will also impart upside to the core inflation. What is good for the core inflation is that there will be the global side of things, which may not be inflationary, but could also be disinflationary, given from the trade side in terms of the flow of goods that could change from let's say export-oriented economies to other countries, and hence there could be a bit of a disinflationary pressures which could come into the Indian context. Overall, see, I think we are kind of reaching a peak in terms of the core inflation. Somewhere around 4.5 to 4.7% should be the peak. But that again is contingent on multiple drivers. But more or less, I think the inching up of the core inflation continues for a bit. But there are certain caps which can come in terms of the global side.
Right. Deepti, if you talk about the growth scenario, the projection which has been given is 6.5%. Do you see there is a scope or a possibility of further reduction in the next policy, or you think that this target will be maintained throughout the year?
Well, I see it's an evolving situation, and therefore most of these forecasts do tend to have a downside. Our own forecast at CRISIL is that growth is our current forecast is 6.5, but it definitely has a downward bias. Now we are looking at two things: the direct impact that comes in because of UF tariffs, because we all know that there will be some, but the bigger indirect impact essentially comes in from the fact that global demand and global growth is expected to be weaker. So India's trade partners seeing weaker growth will also manifest into India's GDP growth. Now, having said that, I don't think that we have a it's not like a big global shock that will materially bring down India's growth forecast, because a lot still depends on domestic drivers. And I think the domestic drivers, one coming in from government's capex spending, the other coming in from consumption holding up because we have lower interest rates, lower inflation, we have the tax rate cuts, etc. I think those will play a large role in terms of supporting growth. So I think we need to look at it from both these perspectives. Also, when we look at the global shock, it's important to understand that there will also be a lot of surpluses now, beginning from what's happening in China and also some other economies. Now, when that comes into India, it will be damaging if we have cheaper intermediate and final goods that we import. But it will be helpful if our manufacturers have access to cheaper input costs. Now, we're already seeing, say, for instance, WPI inflation coming down so dramatically. Non-food WPI is about 1%. Now, if that comes in, then in the inflation will see a significant offset from whatever rupee weakening and higher imported inflation that we could likely see. Similarly, I think growth will also see some support if there are input costs. So therefore, our 6.5% growth forecast that we have in CRISIL, we have a downward bias to it, but it will not materially damage or bring down India's growth forecast for this fiscal.
Right. Madan, what do you think will be the impact of the global scenarios which are playing in? You have seen the kind of Trump tariffs which are yet to be imposed if you talk about the majority of countries. Do you think that could play as a spoil sport?
Definitely, it can play a spoil sport at a margin. See, even though the macro picture is unlikely to be blunted too much on account of these tariffs, we should remember that America is an important export market for us, which means that at the micro level, when I say micro at the industry level, we are definitely going to see quite a bit of disruption taking place. So that is the first thing we have to keep in mind. So if you're looking at industries like even things like pharma and electronics, there could be a special tariff which could be put on those goods. So there's going to be more competition out there. But more importantly, any kind of a bilateral treaty or agreement we have in the United States or any other country would necessarily mean that we are lowering our tariffs, which in turn would mean that there would be more competition for domestic industry. Because the way I look at tariffs is that they have largely been used in order to provide some kind of protection to domestic industry rather than a means to raise revenue. So the revenue part will, of course, get affected in case we lower the tariffs. So, but that, to my mind, is not going to be very significant. But definitely in terms of domestic industry, the kind of competition which is going to come through in case tariffs are lowered significantly for specific industries, there would definitely be a disruption out there. So while the overall GDP growth number, I think we have a forecast of 6.4 to 6.6, which is roughly close to what RBI is saying. We are keeping a range of 6.4, worst case scenario 6.6 otherwise, in case things turn out to be good. But at the industry level, there's definitely going to be disruption. So I think that's where the government has to do some kind of intervention to ensure that we're able to protect these industries, maybe through a finance route, maybe giving other kind of incentives, PLI-like schemes for them, to ensure that we're able to be on our toes at a time when competition increases, both in terms of cheaper imports coming into the country with the reduction of tariffs, as well as competition which Indian commodities would face in global markets on account of the higher tariffs which are there. And because in this entire thing, we should also see how the rupee behaves. If the rupee, now we are seeing that the dollar is actually started depreciating. So that export competitive advantage we get normally when the rupee starts weakening is something we cannot take for granted at this point of time.
Right. Suvodeep, the rural and urban inflation both are below 3.5%. Rural inflation is at 3.25%, and similarly urban inflation is also around 3.4%. What takeaway do you take from these two numbers?
I think takeaway from these numbers are, I would say limited in the first place, because these are, in some sense, depends on the constituents. For example, rural would have a higher weightage of the food inflation, and hence the drop-off would be larger. But I think the bigger point is in terms of the demand side, how much is reflected in the inflation. One of the key elements to remember is that when we are thinking of growth and the impact on, let's say, the urban inflation, there is a fair amount of uncertainty that the global side of things will throw up, whether it is in terms of, the formal jobs or in terms of the exports, manufacturing, etc. There will be a fair amount of uncertainty. And along with that, there will be a kind of a slowdown in the kind of investment demand that you are seeing given the uncertainty. And hence, I think the downside to growth would reflect somewhere in the inflation numbers. Now, whether it is in the rural or the urban depends on how much of the impact percolates through the economy. Having said that, I think important to note that as food inflation comes off, there will be a downside bias to the rural food inflation part or the rural inflation part, which bodes well for the rural economy, which should in some sense increase their purchasing power, and hence kind of support the rural demand. The urban side of things, of course, will be much more open to the global side of things, and we'll see how things pan out over the next year or so.
With the CPI now at 3.34%, Deepti, what do you think will be the bond yield movement? Because expectation was around 3.5%, it has come better than that.
Yeah, I think bond yields will definitely benefit because there is an expectation of lower rate cuts. They've already responded. Lower inflation, lower fiscal. So our expectation is that by March of 2026, we believe the bond yield should be somewhere around 6.4% or so. So I think, see, it's also true that the interim period is going to be a period of a lot of uncertainty. And today, I think more than the impact of what's happening in terms of growth, inflation, rate behavior, etc., it's the fact that globally economies are behaving very differently. For instance, the US is going to expect high inflation. Many of the rest of the world, the other countries, are expected to see disinflation, which basically means that monetary policies are also going to behave very differently in different parts of the world. The ultimate outcome of all of this is going to be an extended period of uncertainty. And uncertainty basically, therefore, yields capital volatility. So we've seen this brief period post-October this year, where we saw a lot of FII leaving the debt markets, and very recently they started coming back. So I think the interim period is expected to see a lot of volatility on, debt flows, capital flows, the rupee, and I think that some of that will also impact the yield. But fundamentally, if you look at where the 10-year GSEC yield was in March 2025 and vis-a-vis that March 2026, clearly these three factors which I mentioned are supported. Lower fiscal deficit, lower inflation, and lower interest rates definitely. So that's how we are looking at the yields.
Definitely. Madan, how much of the rate cut you are anticipating for the whole year?
For the whole year, we're looking at another 50 basis points cut. So I'm taking it to a terminal point of 5.5%. And see, one interesting point is that if you look at what has been the average repo rate since 2012, that is the time when we had this CPI index, it's actually been around 6%. So even today, when I'm talking of 5.5%, because we're going to have this unusual situation where the CPI inflation, we're assuming, is going to be in this region of 4%. So that's why I said 4% plus another 1.5% for adjustment for inflation will actually mean that the repo rate will be coming to around 5.5%. There could be a temporary blip downwards, but that's not something which is going to be sustainable, because I think there will be certain phases even during the course of the current financial year where we could see inflation actually going beyond 4%. So right now we're going purely on the basis of the RBI forecasts, which seem to be benign until December. But any kind of a blip out there, and that could be caused primarily on the food side, something which does push up inflation, could actually mean that we could be broadly talking of the repo rate at 5.5%. That's another 50 basis points cut. So the assumption is 4% inflation. If we have 4%, we could end at 5.5%. And as I said, the timing, there would be one probably in August, maybe not be in June, because you need to assess what monsoon is likely to be or how it's exactly progressing, and maybe another 25 basis points towards the end of the calendar year, or maybe the fiscal year, that is February 2026.
Suvodeep, now the numbers of CPI this month are out, but the bigger question is, if you say next 2 to 3 quarters, even RBI is saying that the inflation will remain below 4%. In your forecast, how much do you see will be a spoil sport kind of bracket which can play later this year?
So I think it's difficult to say because we don't know how vegetable prices will behave, right? And I think that's practically the only joker in the pack. The rest are more well behaved, so to say. And hence, barring any global shocks or sudden supply shocks, etc., vegetable prices is the main risk factor. But I think one point to remember here is that how much of importance would vegetable prices per se be in the growth inflation mix is important to note, because if the concerns on growth are higher than the concerns on inflation, there can be periods when the RBI looks through certain higher prints of inflation, especially ones which are of a short cycle crop. We have seen it in the past. September, October prints have given way to record, not record, but multi-year low in terms of the inflation prints, right? So I think it's important to note what the balance on the growth and the inflation lies. And in that, I think it's important to note that what the global uncertainty implies is that on the domestic side, you could have a weaker private sector investment cycle. You can have certain export-oriented segments, especially on the MSME side, which could be on the weaker side, which could impact consumption in general, right? So from that perspective, the softness on growth could override the any interim transitory spikes in inflation. To that extent, we are looking at a range of 5.8 to 6.2 in terms of the GDP growth, which kind of sets us up for a rate cycle, which is probably the rate cut cycle, which is probably deeper than what the market believes. We are looking at somewhere around 75 to 100 bips.
Right. Fair point, Suvodeep. In the paucity of time, I would want to intervene here. But for now, it is music to ears to at least stakeholders, regulators, that inflation has come in below the range of Reserve Bank of India, below 4%, and not only below 4%, it is 3.34% this month. Thank you so much, Suvodeep, Dipti, and Madan Sabnavis for joining at this hour. But for now, it is over to Reserve Bank of India, because whatever was the script from Reserve Bank of India's Monetary Policy Committee commentary, everything is playing out accordingly. Thanks for watching.